Hello everyone, this is Dr. Mihir Shah once again with another video. This is the continuation of our first part of the video which we had made that was based on adjustment of final accounts and its effects. So we will continue from where we exactly stopped in our last video. So let us start. Adjustment number 16. The adjustment number 16 is based on unrecorded sales of goods. Now, the very first effect of unrecorded sale of goods is that number one, it gets added to sales on the credit side of trading account, and second effect gets added to debtors on the asset side of the balance sheet. So, trading account on the buy side, to sales add unrecorded sales, and in the balance sheet on the asset side it will be debtors add unrecorded sales. That's adjustment number 16. Next, adjustment number 17 is based on commission to partner as a percentage to gross profit. Now the very first effect of that will be the commission part will appear on the debit side of P&L account, and it will be calculated on the gross profit. And second effect, okay, it will either be on the credit side of your current or capital account if you are opening, or it gets added to the capital on the liability side of the balance sheet. So first effect, P&L on the debit side, it will be to commission to partner A or to commission to partner B depending on the name and the number of partners. Or second effect will be capital of that respected partner add commission. So first effect, it comes on the debit side of P&L, second gets added to your capital, or it will be on the credit side of your current or capital account if that is to be prepared. That's adjustment number 17. Next, adjustment number 18. Adjustment 18 is based on interest on partner's capital. First effect will be on the debit side of your P&L account. Second effect, again, it will be either on the credit side of your current or capital account that is to be prepared, or it gets added to capital on the liability side of the balance sheet. So on your P&L, it will be on the debit side to interest on capital of partner A or interest to capital on partner B or whatever may be the name of those partners. And second effect will get added to the capital. So it will be capital of A, add interest on capital of A. Respectively, you'll have to prepare even for B or whatever name of partners are given. That's adjustment number 18. Next, adjustment number 19. Adjustment number 19 is based on sale of assets included in sale of goods. So you're supposed to sell an asset, by mistakenly you have written in sales. So the first effect of that will be that it gets deducted from sales on the credit side of your trading account. And second effect, it will get deducted from the respected asset from the asset side of the balance sheet. So the first effect will be on the credit side of your trading accounts. It will be buy sales less sale of asset. And the second effect on the balance sheet asset side, it will be the respected assets minus sale of asset. That's adjustment number 19. Next, adjustment number 20. Adjustment 20 is based on advertisement expense which is paid for more than 1 year. If it is paid for more than 1 year, it means it is paid in advance, or that is something related to prepaid. So the first effect will always be that we need to show current year's amount on the debit side of P&L account. Only the current year. So extra whatever is available, that will become your prepaid. And second effect will be on the balance amount of advertisement which is prepaid is to be shown on the asset side of the balance sheet as a prepaid advertisement. So first effect, it will get deducted. So from advertisement you'll minus your prepaid, and whatever is pending, that is nothing but your current year's amount. And second effect, whatever was remaining, whatever was prepaid, that comes on the asset side of the balance sheet. That's adjustment number 20. Next, adjustment number 21. Adjustment 21 is based on repairs to assets included in assets. Now remember, repairs is an expense. Asset, okay, is comes under the balance sheet. Repairs is supposed to come on P&L account because it's an expense. So the very first effect, debit side of P&L account, the repairs which is given has to come on the debit side of a P&L account. Second effect, deduct from the respective asset on the asset side of the balance sheet before calculating the depreciation. So in your P&L debit side, we'll just have to write there two repairs on asset, and from your balance sheet asset side it will be asset less repairs on asset, and then whatever amount you get on that you will have to calculate your depreciation. That's adjustment number 21. Next, adjustment 22. Now adjustment 22 is based on bad debts and reserve for doubtful debts. Now always remember, first effect of that, it will be that the complete working of bad debts and reserve for bad debts should come on the debit side of P&L account if the final total is positive. Meaning if the total amount is in positive, it will come on the debit side of P&L, otherwise on the credit side. And second effect, we need to deduct the new bad debts and the new RDD from debtors on the asset side. So in your P&L account on your debit side, the working will look something like this. It will be two bad debts. That is, from the trial balance debit side, you'll get this value. Add new bad debts. Now this value will come from the adjustment. Add new RDD. This also value will come from the adjustment. Less old RDD. Now this value will come from the trial balance credit side. So the working reads at two bad debts, add new bad debts, add new RDD, less old RDD. This is the first effect. Second effect, in the balance sheet on the asset side, it will be debtors less new bad debts which will appear from the adjustment, less new RDD which will again appear from the adjustment. Very important adjustment based on bad debts and reserve for doubtful debts. That's adjustment number 22. Next, adjustment number 23. Adjustment 23 is based on discount on debtors. First effect, it will appear on the debit side of your P&L account. Second effect, calculate and deduct discount on debtors from or after deducting new bad debts and new RDD from debtors on the asset side. Now the first effect is simple, it will just appear on the debit side of P&L account as to discount on debtors. The second effect, balance sheet mein, it will be debtors minus new bad debts minus new RDD. After deducting new bad debts and new RDD from the debtors, whatever is the net amount of debtors, on that you will have to calculate the discount on debtors, and that will again get deducted from the total, and outer column mein the net amount will appear. So bad debts minus new RDD. After that, whatever amount is remaining, on that discount on debtors is calculated. First effect will come on the debit side of P&L account. Second, it will get deducted from that same debtor and it will appear on the outer column. Again, a very important adjustment, adjustment number 23. Next, adjustment 24. Now, adjustment number 24 is based on bill receivable includes a dishonored bill. Number one, the very first effect, it will get deducted from bill receivable on the asset side of the balance sheet. So whatever value of dishonored amount is given, that will first get deducted from bill receivable on the asset side. And the second effect, it will be that the same value, the dishonored value, will have to be added to debtors on the asset side of the balance sheet. So first effect, balance sheet, bill receivable less dishonored bill. Second effect, on the asset side itself, it will be debtors add dishonored bill. this is adjustment number 24. Next, the last adjustment number 25. Now, adjustment 25 is based on bills payable includes a dishonored bill. Bills payable comes on the liability side. So the first effect will be that the amount will get deducted from the bills payable on the liability side of balance sheet. And once it get deducted from bills payable, the second effect is get added to creditors on the same liability side of the balance sheet. So again, both the effects are on the are on the liability side of the balance sheet itself. So first effect, liability mein it will be bills payable less dishonored bill, and second effect it will be creditors add dishonored bill. So these were in total 25 important adjustment based on final account. If you all haven't watched the very first video, I would hope I would prefer you all watching the first video, because in that we had already done around 15 adjustments, and thereafter we continued the remaining in this particular video. I hope everyone has understood various effects of final accounts adjustment and their double effects. Okay, if you like the video, see that you'll subscribe to the channel. Thank you.